When global equity markets sell off, usually the US sells off a little bit less, and that's because it's seen as a safe haven. This year, however, that's not the case. The US is roughly in the middle of the pack of countries. So in this video, we're going to look at the reasons for that, but also whether valuations are now cheap in the US and whether fundamentals support US equity. We'll also look at Federal Reserve policy to see whether that's likely to evolve in a way which will be beneficial for equity markets. Then we turn to my global winners portfolio, which uses momentum to choose the best funds, and you can actually follow this portfolio for free on stockcard.io, which is also sponsoring this video. So let's look at my global winners portfolio in a bit more detail. Here are the cumulative returns year to date across a variety of asset classes represented by individual ETFs. So you can see that the one which has done best is USO, that's the US oil fund, and that's because energy has done well this year. It has fallen since its peak in roughly summer of this year, but it's still holding up pretty well. The vertical dashed red lines you can see here are US Federal Reserve policy announcements. And the one which really knocked markets was the one in June. Then more recently, we saw another downturn when we had the CPI number come out above expectations, and that was just last week. And if we look at the funds which have sold off less, those have generally been the less risky assets. So for example, SHY, which is a short duration treasury fund, GLD, which tracks the value of gold, another safe haven. But then as you dial up the risk, you dial up the losses. So for example, HYG, the high yield bond fund, has sold off about 15%, listed real estate by about 22%, emerging market bonds by about the same. Long duration US treasuries have had their biggest sell off ever. They're down by about 25%, Nasdaq's down by about 28%, and Bitcoin has more than halved. So given the size of these risky asset sell-offs, does that now mean that US equity is cheap? So as I make this video, the S&P is at roughly 38.73, and at that level I've compared it with various forward valuations. So the 5-year average valuation is about 15% above where we are today, and the 60-year average valuation is about 8% below where we are today. So you can think of that, the 60-year average, as the long-term fair value, based on the projections of earnings over the next 12 months. So is US equity cheap right now? Well, not really, but it's nowhere near crisis valuations. For example, during COVID-19, we reached levels which would be 20% below where we are today. And in the global financial crisis, we reached levels which are roughly half of where we are today. So I'd characterize US equity markets right now as just not very expensive, but they're certainly not cheap. What about the opinions of analysts at investment banks? Well, these are kind of turning sour at the moment because they're worried about what's going to happen with Federal Reserve policy as it tightens very aggressively towards the end of this year. But also they're worried about margins because if inflation's very high, it's going to eat away at the profits of companies because input costs increase and not all of those can be passed on to customers. And according to Morgan Stanley's Michael Wilson, he says there's still a long way to go before reality is fairly priced. What does he mean by reality? Well, we're talking about fundamentals, and that's corporate profits. So you can see the forecast profits for the US as the red line here, and the value of the S&P is in black. The two have pretty much tracked each other since 2016, with a dip of course for the pandemic, but then there was a huge increase in earnings following the pandemic. So a lot of this rally has been fundamentally driven. However, while the equity market is now sold off, those earnings forecasts have not yet reflected the grim reality of a US recession with inflation above 8% and sticky. So one of the things to really look out for is what happens to US corporate profits as we go through the next earnings season, which is Q3. Well, one of the first companies to report is PepsiCo, so the ticker for that is PEP, so we can look it up on stockcard.io, and if you scroll down just a little bit, you'll be able to see the key dates for the company, and you can see that the next earnings date is right at the beginning of the Q3 earnings season, which kicks off in October, so PepsiCo will report on October the 11th. And then the end of the earnings season is usually bracketed by FedEx. That's one of the last companies to report. So the ticker for that is FDX. And there's actually been a fairly brutal sell-off in FedEx as it warned about weakness in the global economy. So if we look at the 1 month price history for FedEx, notice this horrendous sell-off just a few days ago. So has it reported yet? Well, actually, no, it hasn't. Certainly not when I've made this video. It doesn't report until September the 22nd. And then the next report will be a quarter after that. So that'll be roughly at the end of December. So if you do want to keep track of what's happening with earnings, stockcar.io is a really great way to do it. And in Stockcar's latest update, they've come up with this absolutely beautiful summary of the fundamentals of a company. Notice that now FedEx is marked as bearish or oversold, and also an undervalued stock. Plus the upside is going to be limited by the fact that it's got limited growth potential. So you can drill into any of these categories to figure out whether you like the stock or not. Now, if we look ahead for growth, it certainly doesn't look good. And one of the leading indicators for growth is the Purchasing Managers' Indices. And here I've shown it for 4 regions and countries. So it's the US, China, the Eurozone, and Japan. And pretty much anywhere you look at, these things are heading south. They've gone below the 50 level. The only exception at the moment is China, which is above 50, but it is falling. What that suggests is that we're going to see a synchronized global slowdown. So if you're a company and you're selling goods and services globally, there's really no country where your sales are going to be improving a lot. So this isn't just a localized slowdown in one country, it's going to be a global phenomenon. And that in turn is going to be bad for corporate earnings and for the equity market globally. Now, investors are used to the idea of the Fed running to the rescue when equity markets sell off. However, now it's a one-mandate Fed, with inflation above 8% and pretty much staying there, and core inflation actually getting worse at the latest update. And remember, it's the core number that the Fed looks at. That suggests that the Fed is not going to be easing off its interest rates or pivoting anytime soon. And if we look at Fed funds futures, we can back up probabilities of rate hikes for every Fed meeting in future. So for example, in September, markets are expecting a 0.75% hike, followed by another one. That'll come in November. And then finally, we'll get one at 0.25, which is the normal rate of increase. And that'll be the December meeting. Only when we get to February of 2023 will we get no hike, according to Fed funds futures. So what you can see is a pattern where the Fed raises interest rates to about 4.5% and it keeps them there for some time. So there will be no Fed running to the rescue of equity markets if they fall. Inflation is the #1 game in town, getting that under control. So as you can tell, this is a fairly gloomy backdrop for equity. So let's just recap how the momentum portfolio works. These are the funds we can choose from. We have 44 single country ETFs, all dollar denominated, 18 factor and style funds, 11 US sector funds, 8 commodity funds, and 9 bond funds. And we select a fund from each of those categories based on momentum, such that one fund from each of the categories makes it through to the portfolio, unless none of the funds within a category have a positive return, in which case it doesn't put forward a fund at all. So we could end up with less than 5 funds in a given month. So how has the fund performed? Well, since 2004, you can see that it's beaten the S&P 500, the Global Winners portfolio, the returns are shown in red, and the S&P shown in blue. And if we look at the drawdown of the S&P and the Global Winners portfolio, that's the fall since the previous all-time high. You can see in 2008 it sold off a bit less. In 2020 it sold off a little bit more than the S&P. And so far this year it's actually sold off less. And over the latest month, while the S&P's dipped further into negative territory, the Global Winners portfolio hasn't. And that's because of its preference for energy. Now let's look at the performance over the last month. There were only 3 funds in the portfolio because 2 of them didn't make it. They didn't have any positive returns. And those 3 funds were XLE, the Energy Select Spider Fund, QAT, the Qatar Single Country ETF, and DBE, which is the PowerShares DB Energy Fund. And all 3 of those outperformed the S&P 500, which fell by roughly 10% over that month. So there was outperformance over the previous month. Hooray! Now, if we'd have had perfect foresight a month ago, which funds would we have chosen? Well, amongst the country funds, Turkey was a surprise outperformer, which rose by 15% compared to the 10% fall of the S&P. Energy, which is the fund we chose, was the best performer, so that was a sector choice. Agriculture was actually better than DBE, the energy fund, and amongst bond funds, all of them fell, but SHY fell least. And amongst factors and styles, you can see that momentum was the best choice, but even that had a negative return. Now, I said you could follow my portfolio for free on stockcar.io. This is what the home screen looks like, and you just type Ramin and it comes under portfolios. So here's Ramin's global winners. And if you look at the changes for this month, you can see that I sold my Qatar ETF and I swapped it for the Turkey ETF. Now, if you want to follow this portfolio, just click on this bell icon in the top right and you'll be notified every time I make a change. Now, you can follow my portfolio for free on stockcar.io, but if you want full access, you'll need a VIP subscription. And there's a special offer for viewers of PensionCraft where you get 10% off your first VIP subscription if you use our promo code PensionCraft with no spaces. There'll be more about that in the description of this video. Now let's look at the allocations for this month. And we can start with countries. Notice that Turkey is actually the top of the return table over our 180-day look-back period, and that's now well above our choice for last month, which was Qatar. If we look at the 3 best performing and worst performing countries over this period, you can see that Turkey simply surged ahead of ECH, which is Chile, and Qatar, which was our choice last month. If we look at factors and styles, none of them had a positive return over the last 180 days, and that means no factor fund is chosen for this month's portfolio. Now our sector choice, and here you can see energy is the clear winner. The one which was second was utilities, but that's way behind energy. In commodities, energy is again a clear winner. Agriculture is a long way behind. And although energy peaked this summer as energy prices have fallen, that's possibly due to the US Strategic Reserve being released, it's still held up pretty well considering that prices have fallen so much. And finally, we'll look at bonds, where again, everything is negative, so no choice for bond fund for this month. So in summary then, our 3 choices for this month are Turkey, where we've substituted it for Qatar. We don't have a factor fund, we don't have a bond fund, and then our sector and commodity choice are again based on the performance of energy. So that's XLE, the Energy Select Spider Fund, and DBE, the PowerShares DB Energy Fund. So it's a pretty downbeat outlook. Federal Reserve policy looks like it's just going to get tighter and tighter, and it's simply a question of whether fundamentals, that's profits, will start to erode in the quarters ahead. And if you do want to keep track of that, well, stockcar.io is a great way to do that. Don't forget our offer with them. If you want to learn more about that, there'll be a link in the description, but simply use our promo code PensionCraft to get that VIP offer. And, as always, thank you for listening.